Now let's talk about how we value non-current liabilities. Now let's first remember what are liabilities. When we start a business, we put in some money of our own, which is your common equity. You take a loan from a bank, that is an example of a liability. And then, of course, you have cash, which is your asset. And then you can use that cash for getting other assets. Now, as you know, on your asset side, you have current assets and non current assets. Just like that, on the liability side as well, you can have current liabilities, right? Such as accounts payable, which need to be paid. So, current liabilities are which need to be paid within a year. But you will have non current liabilities, which are long term liabilities. So, non current liabilities are your long term liabilities. And these are shown at the amount of money you get when you get these liabilities. So let's say you're Amazon and you are selling a bond to the people. So let's say this is not a loan, this is a notes payable, which is what you will show if you are selling bonds to investors. And even though the face value of this bond is 1000, but it is either selling at a higher price than what the face value is because you're offering a 5% coupon, and while the market interest rate is 2%, so people will rush to buy this bond and they will pay a premium for it, which means the cash you will be receiving will be more, and therefore the liability you will be showing will be more. It is a fact that the face value is 1000 and eventually you will only have to pay 1000, so you will reduce it to the face value over the years. It could very well be the case that the rate that you're paying is lower than the market interest rate, and instead of rushing to buy it, people will not be interested in buying your bond, so it might go for a discount instead of a premium, right? In that case, the cash you will receive will of course be lower as well. The liability that you will initially record will be lower as well, but then you will slowly increase it to the face value because the fact of the matter is that you have to pay out the face value at maturity. So long term liabilities are recorded at the amount you receive against them at inception, and then slowly they are taken to their face value. And let's look at an example so that it becomes very, very clear. Let's say you issue 10 million worth of bonds at discount. Why are you issuing this at discount? Probably because the rate you're paying is less than the market interest rate. So people are not willing to give you 100% of this value. They are only giving you 97.5%. So what is 97.5% of 10 million? It is 9.75 million. So that is the amount of cash you will receive, and that is the amount of liability you will report. Now, naturally, you know, at maturity, you have to pay out 10 million because that is the face value. So eventually what you will do is you will amortize it. The liability will be amortized slowly over the, how many years is it? Whatever is the bond's life, right? And you will bring it to 10 million at maturity. So this is the long-term financial liabilities treatment for your balance sheet. Next is deferred tax liabilities. And first, I want you to understand the difference between accelerated method of depreciation versus straight line. Now, this is something which is going to be discussed in detail in subsequent learning modules, but I just need you to have a high level understanding right now that if you're buying an asset, let's say you're setting up a new factory, and the equipment in that factory has a useful life of, let's say, 10 years. Now, you can either allocate that useful life equally across 10 years. So let's say the factory equipment is worth 10 million. You can divide it by 10 years and equally record depreciation of 1 million every year. Or you can go for an accelerated method where you do more depreciation in the earlier years and less depreciation in the later years. Now, the government, as far as tax is concerned, allows the accelerated method. But maybe for your own internal records, you're going to be maintaining your income statement with a depreciation expense of straight line. Now, straight line is going to be a lower depreciation expense in the earlier years, lower expense in the earlier years, right? If you are going for an accelerated, maybe in the first year you will go for 3 million, then 2 million, and then you will come to 1 million. So because accelerated method has higher expense in the earlier years, that means lower profit will be there in the earlier years, and lower profit means lower tax will be there in the earlier years. However, later you're going to have to pay the tax on it eventually, because the total amount of depreciation will be the same eventually, whether you do it in an accelerated manner or in a straight line manner. It's just a temporary timing difference, right? That initially you're doing accelerated method, as far as the government is concerned, you're currently paying a lower tax, but later you will have to pay that tax. So you're going to have a liability that you will record, that even though you haven't paid it now, in the future you will have to pay that tax, and this is called a deferred tax liability. And it is always shown as a non-current liability, because obviously it's going to be more than a year that is going to pass before you have to pay it. You're not paying it within this tax year, right? So anything more than a year is going to be non-current, and this is an example of a non-current liability. Finally, this learning module comes to an end with our discussion of ratios and common size analysis, just like we did for your income statement. So first, let's talk about common size analysis. In the income statement, we made everything as a percentage of sales. Here, we're going to make everything as a percentage of total assets, right? And primarily, what are the two types of ratios that we will be looking at are liquidity and solvency. And liquidity is our ability to meet our current liabilities in the short term, and solvency is our ability to meet our long-term liabilities. Right. So all assets and balance sheet items, that is your liabilities and equity, will be expressed as a percentage of total assets. And similar to your common size statements for income statement, for common size statement for balance sheet also, this is very useful for comparing companies in the same industry. So you can compare the ratios of different companies in the same industry and over time as well. And here is an example of that you can see that as a percentage of total assets, the amount of cash on the balance sheet is going down, right? Amount of accounts receivable is going up, which means more and more money is getting stuck up in client credit, right? Customers are not paying on time. And maybe you can compare it to, so let's say this company Everest is in the business of selling winter clothing, and maybe you can compare it to something called another company like Columbia, that do they also have a similar growing accounts receivable or not? And then coming to ratios, we've got two ratios over here, which is liquidity and solvency. Now liquidity is more short-term focused, so this is regarding our ability to meet our current liabilities, that how much cash or current assets we have that can be used to settle our current liabilities, so that we stay in business, we don't go out of business in the short run within the year, we don't run out of cash within the year. So liquidity ratios are very important, and solvency ratios are also very important, but these are more long term in nature, that not only do they measure your ability to meet your current liabilities, but also all the liabilities, right? So we're looking at the big picture financial risk and leverage over here in terms of the capital structure, that how are you financing your assets? What percentage of your assets are you financing from liabilities versus what percentage of your assets are you financing from equity? And we don't want a very high portion of assets being financed from liabilities, because if the assets go down, right, and let's say you have like a 90% financed by liability and 10% by equity, and if the assets go down 20% to 80, then you don't even have enough money to pay your liabilities, and your equity will get completely wiped out. So that's why solvency ratios are also very important. Now let's have a look at the main liquidity ratios, and I like to give the example of COVID lockdown over here. So let's say there is COVID lockdown and there is no sales happening. So we want to see how each company is going to do in this type of a situation. One ratio to measure Everest's ability to meet its current liabilities is by checking the ratio of current assets to current liabilities. Right, this is called your current ratio. Now, what is included in current assets? You've got your cash, you've got your account receivable, and also you've got your inventory. So these are the major assets, current assets that are there, right? Of course, you have cash and marketable securities. Cash, marketable securities like short-term investments. You even have something called prepaid expenses, right, which we discussed in an earlier video within this learning module. But what I want to emphasize on, and think about the COVID lockdown situation, that can you really use all these current assets to pay for your current liabilities? Can you sell that inventory during the lockdown? Is it possible for you to convert that inventory into cash? Is it possible for you to collect the account receivable from your customers during the lockdown? Highly unlikely. So that means it's not a very good ratio. A more conservative or a safer option is something called the acid test ratio or the quick ratio. And here the difference is that we don't take inventory. It's only cash and marketable securities and receivables. So we exclude your inventory over here, and we even exclude your prepaid expenses over here. We're only taking cash, marketable securities, and receivable. But even now, do you think it is practical to assume that during a lockdown situation you will be able to convert your account receivable to cash? Highly unlikely as well. So that means even a safer ratio than that, even a more conservative ratio than that, is the cash ratio, which only takes cash and marketable securities in the numerator and current liabilities in the denominator. And if this is equal to 1, that is the safest situation, that you have enough cash and marketable securities to settle all your current liabilities. That would be an ideal situation. Solvency ratios are of course more long-term in nature, where we look at long-term debt to equity, and this should be ideally equal, right? If you have 50-50 from both, that means 50% of your assets are financed by long-term loans, 50% by equity, so that's a relatively healthy sign. Total debt to equity, which means not only long-term but short-term as well. And then you have total debt to assets. Again, that will show what percentage of assets are financed by your debt. And then total assets to equity, that what is your financial leverage ratio, that if you have, let's say, assets of 100 and your equity is only 10, that means you are having a 10 times leverage. You're using $10 to get assets under control of $100 because you're borrowing 90, and this is higher is not good. It should be lower, so that the leverage is lower, which, because a higher leverage shows a higher financial risk. All of these should be lower. All of these should be lower because we want lower debt. Lower debt. Okay, so naturally all of this requires some adjustment, requires some judgment. When you're using it to compare different companies, you have to see companies within the industry, what is an average acceptable debt to equity ratio for that industry. Industries like utility companies, which have very stable revenues, like electricity generation and distribution companies, will tend to have higher debt on their balance sheets because their customers are captive customers. They're buying electricity from them. Very, very stable business. However, if you have technology companies, then they should have lower debt to equity ratios. So all of this requires judgment. You have to see the context of the company and its industry before you can do your analysis, right? And of course, balance sheet date is very important. These things they are very sensitive to end of period financing and operating decisions that can impact both your current assets and current liabilities. So you have to see the whole context, both the internal situation of the company and its external economic and industry setting. So that is it for this learning module. Let's have a look at the summary. We talked about intangible assets, both finite and infinite ones. Finite ones have to be measured with amortization, and infinite ones are checked for impairment. Of course, internally generated ones you cannot record, but if you buy one, you can show it, but then it has to be either amortized or tested for impairment annually, right? For internally generated ones, there could be an exception for the development part under IFRS if the technical feasibility is established and you have an intention to sell that asset. Under GAAP, it's almost impossible to do unless the development is for software, and even then, there are some very, very stringent conditions. Goodwill, of course, you can record if you are purchasing it. I gave you the example of Facebook and WhatsApp, and that even still has to be tested for impairment annually. It will not be amortized because it's not a definite useful life. It's not a finite useful life. It is an infinite useful life. Then we talked about the different financial instruments where we said held for trading, available for sale, and held till maturity. Both of these, the unrealized gains are recorded. You're held for trading and available for sale, but the difference is one of them passes through the income statement, the other one passes through the other comprehensive income. And for held till maturity, you are not going to record your unrealized gains. However, your income and realized gains and losses, of course, will flow through the income statement, will be recorded and flow through the income statement for all three of these categories. And then we talked about non-current liabilities. They are shown on amortized costs. We talked about your deferred tax liabilities, which are, of course, because of temporary differences. And finally, we looked at the different liquidity ratios and solvency ratios, and we had a look at common size balance sheet analysis, where you take everything as a percentage of total assets.